Hi, I'm Rick Kahler. Thanks for joining me. What do you think the future holds for the economy and stock market? When someone asks me this, my usual answer is, I don't have a clue. My expertise is in personal financial planning and investing, not economics. There is a difference. Few investment advisors are formally trained economists. Most of us know just enough about economics to be dangerous. But at a recent conference, I had the chance to listen to someone who does have a clue. Bob Dole, Senior Portfolio Manager at Nuveen Asset Management, often discusses investing in the economy on media outlets like Bloomberg TV. Dole says that we are in the middle of a period that he's calling more muddle through. Basically, he doesn't think the markets are going to go either up or down in a sustained manner. Now, that doesn't mean that we should expect calm and quiet stock markets. The 0% return for the first quarter of 2016 was anything but calm. It included a record-setting double-digit drop, followed by a double-digit recovery. Dole reviewed the first 45 days of the year to attempt to explain why, in January, we had the steepest drop on record in the U.S. market. The reasons he cited were fear over a recession, fear that oil prices would continue to fall, fear that China's slowdown was heading them into a black hole, and fear that the Federal Reserve would have 5 interest rate hikes, and fear over the U.S. elections. Then he gave the reasons for the sharp rally in the stock market during the last 45 days of the quarter. Again, a double-digit rise. Well, investors decided there wouldn't be a recession after all. That oil prices probably wouldn't fall to zero and probably would eventually rise. That even with the slowdown in China, it was still the world's second fastest growing economy, and that the Fed would probably only raise rates once or twice. And that whoever is the next president, it's going to be a disaster anyway. Dole explained that investors often get fear funk, a tendency to believe any negative news they hear without regard to the facts. Imagine that. For example, he noted most politicians are telling us how terrible things are in America. Yet we've added more jobs in the past 5 years than at any time in history, 89% of them full-time. This is one reason he feels the chance of a recession is zero this year. Others are a strong job growth, the beginning of wage growth, the fact that individuals are paying off debt and increasing assets, and the economy enjoying the benefit of low oil prices. However, everything isn't all positive. Dole warned that the national deficit will rise for several years. However, the national debt is rising slower than GDP, so the debt to GDP ratio is actually falling, which is a really good thing. His biggest worry is that the U.S. has the world's highest marginal tax rate on businesses and the highest taxation on repatriated earnings. He said this more than anything will serve as a real restraint to a vibrant economy. When asked where he thought the stock market would end the year, Dole reiterated he really doesn't know either. It usually does well in election years, he said, except for an average decline of 4% when a president has been in office 8 years, as President Obama has. Still, if he had to guess, he thinks stocks will reverse this trend and be up around 7% this year. He added that over the long term, he expects a diversified portfolio of 60% stocks commodities and alternatives, and 40% bonds to return 6%, with inflation averaging 3 to 4%, giving real returns of 2 to 3%. And this is completely in line with my historical estimates. Even though most investment advisors, and myself included, aren't economists, we do understand one important thing. The strongest safeguard against economic ups and downs is diversified investing focused on the long term. Thanks for joining me.